Question 1. Annuity phases. Distribution phase. During the payout phase of an annuity, Mrs. Collins has chosen a life annuity with period certain option. This means her annuity will provide income for her lifetime, but also includes a guarantee period. If Mrs. Collins passes away during the guarantee period, what happens to the remaining payments? A. The remaining payments are forfeited to the insurance company. B. The remaining payments are paid to Mrs. Collins's designated beneficiary. C. The remaining payments are redirected to a charity selected by the insurance company. D. The insurance company may choose to continue payments if the annuity balance allows. Answer: B. The remaining payments are paid to Mrs. Collins's designated beneficiary. Explanation: in a life annuity with period certain payout option, the annuitant is guaranteed payments for life with an additional feature of a guaranteed payment period, such as 10 or 20 years. If the annuitant passes away within this period, payments continue to a designated beneficiary for the remainder of the guarantee period. This option balances longevity protection, lifetime income, with a benefit to heirs if death occurs early in the payment period. According to Pennsylvania Department of Insurance regulations and annuity contract guidelines, this structure ensures that the annuity provides both financial security for the annuitant and a potential legacy for beneficiaries during the period certain. Question 2. Taxation of annuities. LIFO rule. Mr. Turner, age 59, decides to take a partial withdrawal from his non-qualified annuity. His annuity has accumulated both the principal and earnings, but he only wants to withdraw from the earnings portion. Under the IRS LIFO last in, first out tax rule, how will this withdrawal be taxed? A. Mr. Turner will only be taxed on the principal portion of the withdrawal. B. Mr. Turner will be taxed on the entire amount of the withdrawal as it will be treated as interest. C. Mr. Turner will not be taxed on this withdrawal due to his age. D. Mr. Turner will be taxed only on the earnings portion and may incur an additional penalty. Answer: D. Mr. Turner will be taxed only on the earnings portion and may incur an additional penalty. Explanation: for non-qualified annuities, the IRS mandates LIFO taxation on withdrawals. This means the last funds in the annuity earnings are considered to be withdrawn first. Consequently, any withdrawal Mr. Turner makes will be considered to come from earnings first, which are taxable as ordinary income. Additionally, because he is under age 591, where he may be subject to a 10% early withdrawal penalty on the taxable portion. According to IRS guidelines and Pennsylvania tax regulations, non-qualified annuities differ from qualified annuities in that they do not receive special tax treatment upon withdrawal, and withdrawals from earnings are typically subject to both income tax and potential penalties. Question 3. Scenario-based question on annuity riders and benefits. Mrs. Garcia, age 67, has an annuity contract that includes a guaranteed minimum withdrawal benefit divider. She is concerned about market volatility and wants to ensure that she can receive a consistent income without depleting her annuity value. Which option best explains how the GMWB rider can assist Mrs. Garcia in meeting her income needs? A. The GMWB rider allows her to withdraw a set percentage annually regardless of market conditions until her contract value reaches zero. B. The GMWB rider guarantees a minimum account balance regardless of withdrawals for the lifetime of the contract. C. The GMWB rider enables her to convert her annuity into a life annuity that cannot be surrendered. D. The GMWB rider allows for unlimited withdrawals without impacting the annuity's cash value. Correct answer: A. The GMWB rider allows her to withdraw a set percentage annually regardless of market conditions until her contract value reaches zero. Answer: A. The GMWB rider allows her to withdraw a set percentage annually regardless of market conditions until her contract value reaches zero. Explanation: a guaranteed minimum withdrawal Benny-Deba rider provides Mrs. Garcia with a guarantee of a specified percentage she can withdraw annually from her annuity without regard to market performance. This benefit is typically based on a percentage of her initial investment or a set benefit base and allows her to maintain predictable income even in volatile markets. However, withdrawals under a GMWB rider will reduce the annuity's cash value over time, potentially down to zero if she lives beyond the contract's accumulation. Despite this, the rider ensures that she will continue receiving payments for a specific period or potentially for life, depending on the contract. Under Pennsylvania annuity suitability regulations, riders such as the GMWB are selected based on the client's income security needs and risk tolerance. They are designed to provide retirees like Mrs. Garcia with a safeguard against market downturns, aligning with both income guarantees and longevity considerations. Question 4. Basics of annuities. Types of annuities. A variable annuity offers growth potential by investing in sub-accounts which are tied to the stock market. Which of the following statements best describes the primary risk associated with a variable annuity? A. Variable annuities guarantee a minimum rate of return, protecting the investor from market losses. B. Variable annuities have low fees because they offer investment flexibility. C. Variable annuities are exposed to market risk, meaning the account value can fluctuate based on the performance of the underlying investments. D. Variable annuities are backed by state guarantee associations, ensuring the principal is protected. Answer: C. Variable annuities are exposed to market risk, meaning the account value can fluctuate based on the performance of the underlying investments. Explanation: Variable annuities differ from fixed annuities in that they are tied to investment sub-accounts, often in the stock and bond markets, meaning they do not offer a guaranteed return and are subject to market risk. This risk can cause the account value to fluctuate based on market performance, which may lead to potential gains or losses. While variable annuities allow for potential growth, they also expose investors to market volatility. According to Pennsylvania annuity regulations and SEC guidelines, variable annuities are intended for individuals with a higher risk tolerance and an understanding of investment risks. State guarantee associations may provide limited protection in case of insurer insolvency, but they do not guarantee market returns. Question 5. Analyzing annuity products for client needs. Which of the following scenarios best illustrates an appropriate use of a fixed indexed annuity for a client? A. A young investor looking for high growth potential with maximum market exposure. B. A retiree seeking principal protection with the possibility of moderate growth tied to a market index. C. A high net worth individual looking for complete liquidity in all of their investments. D. A middle-aged professional with a high risk tolerance wanting access to diversified stock sub-accounts. Answer: B. A retiree seeking principal protection with the possibility of moderate growth tied to a market index. Explanation: A fixed indexed annuity (FIA) provides principal protection with growth potential linked to a specified market index like the S&P 500. While the annuity's account value can increase if the index performs well, there is often a cap on potential returns and the principal is protected from direct losses. This makes FIs particularly suitable for conservative investors or retirees who need some growth while avoiding the full exposure to market volatility associated with variable annuities. Pennsylvania's annuity suitability standards require that advisors consider the client's objectives, risk tolerance, and income needs, making FIs more appropriate for those with low risk tolerance who still want moderate market-linked growth. Question 6. Taxation of annuities, qualified versus non-qualified. Dr. Patel owns both a qualified annuity funded through his 401k rollover and a non-qualified annuity funded with after-tax dollars. How will his withdrawals from each annuity be taxed in retirement? A. Withdrawals from both annuities will be entirely tax-free as long as Dr. Patel is over age 591. B. Withdrawals from the qualified annuity are fully taxable, while only the earnings portion of the non-qualified annuity is taxable. C. Both annuities will be taxed only on the earnings portion as they both grow tax-deferred. D. The qualified annuity allows tax-free withdrawals, while the non-qualified annuity will be fully taxable. Answer: B. Withdrawals from the qualified annuity are fully taxable, while only the earnings portion of the non-qualified annuity is taxable. Explanation: A qualified annuity is funded with pre-tax dollars, meaning the entire amount, principal and earnings, is taxable upon withdrawal as ordinary income. In contrast, a non-qualified annuity is funded with after-tax dollars, so only the earnings portion is subject to tax when withdrawn, while the principal remains tax-free. These tax treatments follow IRS regulations on annuity taxation and reflect Pennsylvania's guidelines on tax-deferred investments. For individuals like Dr. Patel, understanding these distinctions is crucial for tax planning in retirement. Question 7. Regulation and compliance. NAIC Annuity Suitability Model Regulation. Under the NAIC Annuity Suitability Model Regulation, what is the primary responsibility of an insurance producer when recommending an annuity to a client? A. The producer must prioritize the commission structure that benefits them the most. B. The producer is required to recommend the annuity based solely on the client's age. C. The producer must make a reasonable effort to obtain information regarding the client's financial status, tax status, and investment objectives. D. The producer should only present annuities with fixed interest rates. Answer: C. The producer must make a reasonable effort to obtain information regarding the client's financial status, tax status, and investment objectives. Explanation: according to the NAIC Annuity Suitability Model Regulation, an insurance producer must assess the client's suitability by gathering information on their financial status, tax situation, and investment goals before recommending an annuity. This is to ensure that the recommended annuity aligns with the client's needs and objectives rather than the producer's personal interests. In Pennsylvania, producers are also required to follow these guidelines to protect clients from unsuitable annuity sales, emphasizing the fiduciary duty to act in the client's best interest. Question 8. Market trends and economic influences on annuities. How would a significant rise in interest rates most likely impact the benefits of new fixed annuity contracts? A. It would have no impact, as fixed annuities are not influenced by economic changes. B. It would decrease the guaranteed interest rate offered on new fixed annuity contracts. C. It would likely increase the guaranteed interest rate offered on new fixed annuity contracts. D. It would force insurance companies to convert all fixed annuities to variable annuities. Answer: C. It would likely increase the guaranteed interest rate offered on new fixed annuity contracts. Explanation: when interest rates rise, insurance companies typically increase the guaranteed rates offered on new fixed annuity contracts to remain competitive with other investment products like CDS and bonds. Higher rates make fixed annuities more attractive as they can offer improved returns without market exposure. This principle is based on Pennsylvania annuity market trends and general economic theory, where insurance companies must adjust rates in response to economic changes to attract new annuity buyers. Question 9. Ethics and suitability in annuity sales. Which of the following practices is considered unethical and a violation of Pennsylvania's annuity suitability regulations? A. Recommending an annuity that aligns with the client's stated income needs and risk tolerance. B. Fully disclosing all fees and surrender charges to the client before purchase. C. Selling a deferred annuity to an elderly client with a short life expectancy without disclosing the potential lack of liquidity. D. Advising the client on how the annuity can be a part of their retirement income strategy. Answer: C. Selling a deferred annuity to an elderly client with a short life expectancy without disclosing the potential lack of liquidity. Explanation: in Pennsylvania, annuity sales must align with suitability and ethical standards to ensure the client's best interest is prioritized. Selling a deferred annuity to an elderly client without fully explaining the lack of immediate liquidity can be unsuitable and unethical. The NAIC Suitability Model Regulation and Pennsylvania guidelines emphasize transparency and suitability in annuity sales, especially for older clients who may need immediate access to funds. Ethical practices require full disclosure and alignment with the client's financial needs and objectives, avoiding misrepresentation or omission of material information. Question 10. Estate planning with annuities. Which of the following options best describes how a spousal continuation provision in an annuity affects the estate planning process? A. It allows the spouse to receive a one-time lump sum payment of the remaining annuity balance. B. It enables the surviving spouse to continue the annuity contract with the same tax-deferred status, avoiding a taxable event. C. It forces the surviving spouse to annuitize the contract and begin withdrawals immediately. D. It limits the spouse's ability to transfer the annuity to another beneficiary. Answer: B. It enables the surviving spouse to continue the annuity contract with the same tax-deferred status, avoiding a taxable event. Explanation: the spousal continuation provision in an annuity contract is particularly beneficial for estate planning, as it allows the surviving spouse to defer taxes on the annuity's earnings until they choose to make withdrawals. This provision aligns with the Internal Revenue Code and Pennsylvania's state regulations on annuities, which permit the continuation of tax deferral when ownership transfers to a surviving spouse. The surviving spouse has the flexibility to either continue the contract benefiting from ongoing tax-deferred growth or start receiving income based on the payout options outlined in the contract. By avoiding an immediate taxable event, the spousal continuation provision can help preserve the annuity's value for future financial security and mitigate the tax impact on the estate. Question 11. Regulation and compliance. Which of the following is required under Pennsylvania's annuity suitability regulations when an agent recommends an annuity product to a client? A. The agent must disclose all available annuity products from competing insurance companies. B. The agent must assess and document the client's financial status, tax status, investment objectives, and other relevant information. C. The agent is only required to disclose fees if the client requests specific details about charges. D. The agent must provide a summary of the insurance company's financial strength ratings. Answer B. The agent must assess and document the client's financial status, tax status, investment objectives, and other relevant information. Explanation. Under Pennsylvania's annuity suitability regulations and the NAIC suitability model, agents must collect and document relevant information about a client's financial situation, including their income, tax status, investment objectives, and risk tolerance, to ensure the annuity recommendation is appropriate. Option A is incorrect, as agents are not required to disclose competing products. Option C is misleading, as fee disclosure is required regardless of client requests. Option D is incorrect because financial strength ratings are not part of the suitability assessment requirements. Question 12. Types of annuities. What distinguishes a fixed indexed annuity from a variable annuity? A fixed indexed annuity offers guaranteed minimum returns, while a variable annuity does not guarantee any returns. B. A fixed indexed annuity involves market-linked investments with subaccounts, while a variable annuity is linked to a specific index. C. Both types of annuities have caps on gains, but only variable annuities protect against losses. D. Both types of annuities depend on the stock market for returns without any protection from losses. Answer A. A fixed indexed annuity offers guaranteed minimum returns, while a variable annuity does not guarantee any returns. Explanation. A fixed indexed annuity provides a minimum interest rate guarantee along with potential interest credits based on a market index. In contrast, variable annuities are directly tied to the performance of selected investment subaccounts and typically do not guarantee returns, leaving the policyholder fully exposed to market fluctuations. Options B, C, and D are incorrect, as they misrepresent the core distinctions between fixed indexed and variable annuities. Question 13. Market trends and economic influences. If inflation rates are expected to rise significantly, which type of annuity might be least impacted by inflation, and why? A. Fixed annuity, because of its predictable payouts. B. Variable annuity, because its value can adjust with market performance. C. Fixed indexed annuity, because it offers both guaranteed and market-linked potential. D. Immediate annuity, as it guarantees immediate lifetime income. Answer B. Variable annuity, because its value can adjust with market performance. Explanation. A variable annuity may better withstand inflation because its returns are linked to investment subaccounts that can benefit from rising prices, unlike a fixed annuity, which may lose purchasing power over time due to fixed payments. Option C could offer limited inflation protection, but typically includes caps and participation rates that may not fully offset inflation. An immediate annuity is fixed and would not adjust for inflation. Question 14. Taxation of annuities. Which taxation rule applies to withdrawals from a non-qualified annuity? A. All withdrawals are tax-free due to the initial after-tax contributions. B. Withdrawals are taxed as capital gains. C. Earnings are taxed as ordinary income under the last and first out LIFO rule. D. Withdrawals are tax deferred until age 701 WO. Answer C. Earnings are taxed as ordinary income under the last and first out LIFO rule. Explanation. Non-qualified annuities follow the LIFO rule for taxation, meaning earnings, interest, and investment gains are withdrawn first and taxed as ordinary income. Contributions made with after-tax dollars are withdrawn last, tax-free. Options A and B are incorrect, as only the earnings are taxed and they are taxed as ordinary income, not capital gains. Option D is irrelevant, as withdrawals can occur at any age, although penalties may apply before age 591 were. Question 15, scenario-based. Payout options. Mr. Evans, age 65, is considering an annuity payout option that would provide him with income for life, but would also ensure a portion of the payments continues to his wife if he passes away. Which payout option best suits Mr. Evans's situation? A. Single life annuity. B. Life annuity with period certain. C. Joint and survivor annuity. D. Lump sum payout. Answer C. Joint and survivor annuity. Explanation. A joint and survivor annuity provides lifetime income for Mr. Evans and ensures his spouse will continue to receive a portion of the income after his death. This option aligns with his desire to provide financial support to his wife. Options A, B, and D do not meet his needs as they either end with his death or provide only a limited time frame for payments after his passing. Question 16. Tax-deferred earnings. Why is tax deferral considered a significant benefit of annuities? A. It allows immediate access to investment earnings without taxes. B. It enables growth without immediate tax on earnings until withdrawals are made. C. It eliminates taxes on gains permanently. D. It applies only to qualified annuities. Answer: B. It enables growth without immediate tax on earnings until withdrawals are made. Explanation: the tax-deferred status of annuities allows earnings to grow without immediate tax, enhancing compounding potential. This deferral continues until withdrawals, which can help accumulate more wealth over time. Options A and C misrepresent the nature of tax deferral, as taxes are deferred, not eliminated. Option D is incorrect, as both qualified and non-qualified annuities offer tax deferral on earnings. Question 17. Fixed indexed annuities. What does a cap in a fixed indexed annuity signify? A. It limits the maximum potential loss an investor can incur. B. It sets the maximum annual rate of return regardless of index performance. C. It guarantees a fixed interest rate irrespective of index performance. D. It represents a limit on the minimum guaranteed return. Answer: B. It sets the maximum annual rate of return regardless of index performance. Explanation: in a fixed indexed annuity, the cap is the maximum interest rate credited based on index performance. Even if the index performs above the cap rate, the annuity only credits up to the capped rate. Options A, C, and D are incorrect as they describe features not related to the cap. Question 18. Suitability and client needs. Which client profile is best suited for a deferred annuity with a guaranteed minimum withdrawal benefit rider? A. A client seeking immediate, high-yield returns. B. A client looking for flexible access to funds without withdrawal limits. C. A client focused on tax-free withdrawals. D. A client concerned about outliving their retirement savings. Answer: D. A client concerned about outliving their retirement savings. Explanation: the GMWB rider provides a guaranteed income stream regardless of market performance, making it suitable for clients concerned about longevity risk. Options A, B, and C are incorrect, as GMWB riders are more appropriate for clients focused on long-term income stability rather than immediate high returns, unrestricted withdrawals, or tax-free withdrawals. Question 19. Risk management. How do mortality and expense to meet charges in variable annuities impact policyholders? A. They decrease the overall rate of return by covering insurance-related risks. B. They guarantee a minimum rate of return on the annuity. C. They cover losses incurred from market fluctuations. D. They only apply to fixed annuities. Answer: A. They decrease the overall rate of return by covering insurance-related risks. Explanation: mortality and expense charges cover the insurance company's cost of providing the death benefit and other administrative expenses. This reduces the overall return on investment for the annuity holder. Option B is incorrect, as charges do not guarantee returns. Option C is also incorrect, as these charges do not protect against market losses. Option D is irrelevant, as charges are specific to variable annuities. Question 20. Ethical sales practices. Which of the following actions is considered unethical when selling annuities? A. Discussing only the annuity's potential gains while omitting information on risks and fees. B. Providing clients with information on tax advantages. C. Explaining the annuity's benefits and drawbacks based on client suitability. D. Using financial strength ratings to support the company's reliability. Answer: A. Discussing only the annuity's potential gains while omitting information on risks and fees. Explanation: presenting only the positive aspects of an annuity while omitting risks or fees violates ethical sales practices and Pennsylvania's regulations on disclosure and fair practices in annuity sales. Full disclosure of both risks and benefits, including the potential for losses, fees, and charges, is required to ensure that the client is making an informed decision. Options B, C, and D are ethical and within legal guidelines, as they involve providing the client with necessary information to make an informed and suitable decision regarding the annuity. Question 21. Annuity surrender charges. What is the purpose of a surrender charge in an annuity contract? A. To penalize the annuity holder for early withdrawals, ensuring the insurer recoups the initial commission and expenses. B. To provide a tax penalty on earnings withdrawn before age 591 WO. C. To compensate for fluctuations in the annuity's underlying investments. D. To guarantee that the contract will always be renewable after the surrender period ends. Answer: A. To penalize the annuity holder for early withdrawals, ensuring the insurer recoups the initial commission and expenses. Explanation: surrender charges are fees imposed by the insurer when the policyholder withdraws funds before the contract's specified surrender period has elapsed. These charges help the insurer recover the costs associated with issuing the annuity, including commissions and administrative expenses. Options B, C, and D misrepresent the purpose of surrender charges. Question 22. Market risk and annuities. Which of the following annuities carries the most market risk to the annuity holder? A. Fixed annuity. B. Variable annuity. C. Fixed indexed annuity. D. Immediate annuity. Answer: B. Variable annuity. Explanation: a variable annuity exposes the policyholder to market risk because the return depends on the performance of the selected sub-accounts, which are often invested in stocks, bonds, or mutual funds. The policyholder can experience gains or losses based on market performance. In contrast, fixed annuities provide guaranteed returns, and fixed indexed annuities offer some market exposure but with protection from losses due to a minimum guaranteed return. Immediate annuities are typically not subject to market risk as they offer fixed periodic payments. Question 23. Annuity riders. What is the main advantage of purchasing an annuity with a long-term care LTC rider? A. It guarantees a higher return on investment than a standard annuity. B. It provides a benefit to cover long-term care expenses while maintaining the annuity's income stream. C. It offers a lump sum payment for long-term care costs in the event of an illness. D. It eliminates the need for long-term care insurance. Answer: B. It provides a benefit to cover long-term care expenses while maintaining the annuity's income stream. Explanation: an annuity with a long-term care LTC rider helps cover the cost of long-term care while continuing to provide the annuity holder with regular income payments. This rider allows the policyholder to access funds to pay for long-term care expenses without interrupting the annuity's income stream. Options A and C are incorrect because the rider does not typically increase returns or provide lump sum payments for LTC. Option D is also incorrect as the LTC rider supplements, not replaces, long-term care insurance. Question 24. Fixed annuity interest rates. Which factor directly influences the interest rate credited to a fixed annuity? A. The performance of stock market indices. B. The insurer's expense and administrative costs. C. The overall bond market and interest rates in the economy. D. The individual's credit score. Answer: C. The overall bond market and interest rates in the economy. Explanation: the interest rate for a fixed annuity is primarily influenced by economic interest rates, including bond yields, since insurance companies invest in bonds to back their fixed annuity contracts. This rate is fixed and does not depend on the stock market performance or the policyholder's credit score. Option B refers to insurer costs but does not directly affect the rate credited to the policyholder's account. Question 25. Annuity beneficiaries. When naming a beneficiary for an annuity, which of the following should the annuity holder consider to avoid unintended tax consequences? A. The beneficiary's age and financial situation. B. Whether the beneficiary is a family member or a non-relative. C. The potential for tax-free withdrawals upon the beneficiary's death. D. The annuity's surrender period length. Answer: A. The beneficiary's age and financial situation. Explanation: when naming a beneficiary, the annuity holder should consider the age and financial situation of the beneficiary because these factors can influence the tax treatment of the annuity proceeds. For example, younger beneficiaries may be required to take distributions over a longer period, potentially resulting in larger tax liabilities. The other options are not directly related to tax consequences for the beneficiary. Question 26. Annuity liquidity. Which type of annuity provides the least liquidity due to restrictions on withdrawals or early surrender charges? A. Immediate annuity. B. Fixed annuity. C. Variable annuity. D. Fixed indexed annuity. Answer: B. Fixed annuity. Explanation: A fixed annuity typically has less liquidity because it often imposes surrender charges and limits on withdrawals during the early years of the contract, while immediate annuities provide no liquidity after the annuity starts. Variable annuities and fixed indexed annuities tend to allow more flexible withdrawals, although they may still impose penalties for early withdrawals. Question 27. Death benefits in annuities. Which of the following statements about the death benefit of a variable annuity is correct? A. The death benefit is guaranteed to be equal to the total premiums paid, regardless of the performance of the underlying investments. B. The death benefit is equal to the annuity value at the time of death, which may fluctuate with the performance of underlying investments. C. The death benefit is a fixed amount that does not change over the life of the contract. D. The death benefit is only available if the annuity contract has not yet been annuitized. Answer: B. The death benefit is equal to the annuity value at the time of death, which may fluctuate with the performance of underlying investments. Explanation: in a variable annuity, the death benefit is typically equal to the current market value of the annuity account, which can fluctuate based on the performance of the investments chosen by the annuity holder. The guaranteed death benefit is an optional rider that may provide additional protection in case of poor market performance, but the basic death benefit will fluctuate with market conditions. Option A is incorrect because it refers to a guaranteed minimum death benefit, not the typical range. Question 20. Annuity suitability. When considering whether an annuity is suitable for a client, which factor is most important? A. The annuity's high potential for returns. B. The client's age and risk tolerance. C. The insurance company's advertising materials. D. The availability of a death benefit rider. Answer: B. The client's age and risk tolerance. Explanation: the client's age and risk tolerance are key factors in determining whether an annuity is suitable. Annuities are often used to provide a steady income stream, and it's crucial to match the product to the client's financial goals and risk preferences. A younger, more risk-tolerant client may prefer a different product than an older, more risk-averse client. Option A, C, and D do not fully account for the client's specific needs and suitability. Question 29. Annuity transfers and exchanges. Which statement best describes the concept of a 1035 exchange in the context of annuities? A. It is a method of transferring funds between different investment accounts. B. It allows for the tax-free exchange of one annuity contract for another provided certain conditions are met. C. It is a penalty-free withdrawal of funds from an annuity before the age of 591 wo. D. It refers to the process of rolling over an annuity into a retirement account. Answer: B. It allows for the tax-free exchange of one annuity contract for another provided certain conditions are met. Explanation: a 1035 exchange allows an annuity holder to exchange one annuity contract for another without triggering immediate taxes on any gains. However, certain IRS rules must be met for the exchange to be tax-free. Option A is incorrect, as a 1035 exchange is specific to annuities, not other investment accounts. Options C and D do not accurately describe the 1035 exchange process. Question 30. Annuity taxation. Which of the following best describes how withdrawals from an annuity are taxed? A. Only the principal is taxed and any earnings are tax-free. B. Both the principal and the earnings are taxed as ordinary income when withdrawn. C. Withdrawals from an annuity are tax-free if the account is held for more than 10 years. D. Withdrawals are taxed as capital gains, regardless of the annuity's performance. Answer: B. Both the principal and the earnings are taxed as ordinary income when withdrawn. Explanation: withdrawals from an annuity are generally taxed as ordinary income, with both the principal and the earnings subject to tax. This is because the funds in the annuity grow on a tax-deferred basis, meaning taxes are due upon withdrawal. Option A is incorrect because both the principal and the earnings are taxable, not just the earnings. Option C is incorrect because there is no 10-year tax-free rule for annuities. Option D is incorrect because annuity withdrawals are taxed as ordinary income, not capital gains.